Another volatile week in the markets has even the stock market looking a little bit wobbly. Cryptocurrencies like Bitcoin down sharply. We've got repo facility usage again, SOFR rates that are elevated, WTI that briefly went completely sideways in contango. And we can keep going on. The Federal Reserve, the Federal Reserve Bank of New York, the open market desk operator there, a fellow by the name of Purley said, we are probably not that far away from the next QE out of the Fed, in a point that was echoed by the head of the Federal Reserve Bank of New York, Mr. John Williams, who said basically the same thing. The mess in repo representing illiquidity across the wholesale markets, that is, as we've been talking about, very much related to the deterioration of the macroeconomic condition, which seems to have gotten to the point that it's even bothering, as I mentioned, stocks, crypto, and other risk-taking markets. Maybe that's a good place to start with Bitcoin, not as a competing currency to the US dollar or really the Eurodollar system, but as a measure of risk-taking capacity and perceptions, because let's face it, with people questioning the AI bubble as well as macroeconomic circumstances, Bitcoin has found itself under harsh scrutiny as well. So Steve, Mr. Van Meter, where do you want to start this week? It was quite an interesting week in basically every direction. We had layoff announcements in the real economy. We've got repo stuff going on. The Fed saying, hey, you and Steve, Jeff and Steve are right. We're, ending QT doesn't seem to be working. We're probably going to have to do a QE. We got WTI, contango. We've got the Chinese statistics. Really an interesting week here.
Yeah, Jeff, I think it's kind of interesting because let's start talking about reserves, because, we've heard the Fed say we need to get down to approximately a certain level, which you and I know is totally bogus, because not long ago, before the financial crisis, the system had no reserves and functioned just fine. But nobody knows what this level is. We just have an assumed point where maybe the reserves are going away. But then all of a sudden, the SOFR rate starts to be ahead of the funds rate. And everyone's like, oh, no, look, there's clear evidence there aren't enough reserves here, and we need more reserves. And next thing you know, everyone's panicking. We need to cut QT, maybe even do QE. In fact, that's what we heard from the New York Fed. So it's kind of interesting to me that everyone's pointing out the SOFR rate and saying, look, this is evidence that the Fed went too far.
Yeah, it's not evidence the Fed went too far. It's evidence that the system is not liking what it's seeing. And there's a couple of easy ways to see exactly what Steve is talking about here. Number one, there are twice as many bank reserves today as there were back in 2019 when we went through the same repo mess. By the way, under the same exact circumstances, we had a recession scare in the economy. We had central banks that were cutting rates in response to the recession scare in the economy that may or may not have been a recession scare. We'll never know. And we had tightness across not just in repo markets and SOFR rates, but in other things that we monitor and talk about and really focus on as well. But one of the ways you can tell this is not bank reserves is just look at the SOFR dispersion. And the Federal Reserve Bank of New York puts this out every day for you. Just go to the FRBNY's website. Right on the right-hand side of the panel, you see the SOFR rate. You click on that, you get to the full dispersion. Maybe people don't realize there is no single repo rate. There is no single SOFR rate. There's actually thousands of individual transactions that take place every single day. And Federal Reserve Bank of New York takes all that transaction detail and comes up with a weighted median for what they think is the most representative rate of the entire SOFR market. So what we have seen is not just the SOFR representation, the benchmark rates start to creep up. We've seen the entire spread. The entire marketplace is moving higher and higher in terms of interest rates. And when you realize that entire market that's represented by the range of interest rates is roughly 3 trillion, how does a couple billion in bank reserves end up pushing the entire marketplace up to where we have SOFR rates that are well above the federal funds upper limit, as well as IOR, and way above the Fed's reverse repo? So what I'm saying here is that this is not the Fed. The entire repo market is seeing tightening that has pushed the entire, multi-trillions of daily of transaction volume to higher and higher rates. Meanwhile, we're supposed to believe the Fed over here is going to cut back its pace of quantitative tightening and balance sheet reduction by a couple $1 billion, and therefore that's going to magically fix everything. It doesn't make any sense because it's not really supposed to make sense.
Yeah, Jeff, that's exactly it. Because you've really two issues here. You have real issues with the plumbing of the system, and then you have over here Wall Street that's saying, "God, we really want the Fed to cut rates. We really want QE because we want people to buy stocks, and we want them to buy because we're looking over there and going, hey, the situation's not too good and we need people to buy so we can sell. So they're out there saying, look, Fed, it's all you. And the Fed's going, oh yeah, look, it's us. We went too far. And now we're like, we got to do QE. And what happens, investors, Jeff? They come in and buy the dip. And that's what makes it interesting to me, because you and I know it has nothing to do. The Fed can't fix this because announcing the end of QT didn't, doing rate cut didn't. But yet on the other side of the table here, everybody's panicking, and for really good reasons. Because when you get liquidity problems, what happens? And we've seen this over and over. Stock sell, gold sells, bond sell, crypto sells, everything starts to sell. So what do you need if you see that coming? You need to get people to buy.
That's it, Steve. It's always that's the people don't realize the Fed is not a money printer. It's not a central bank in any way. Its sole purpose is to try to perk up sentiment, to try to make people optimistic. You don't need to know what the Fed does. Just understand that when they do a balance sheet operation, that it does something positive somewhere for somebody. You know, or when it's in the case of quantitative easing, as we'll hear from the mainstream media, it's equivalent to pouring hundreds of billions, if not trillions of dollars into the economy. None of it is true. It's absolutely false, and it's demonstrably false. But if you believe that, if you believe in Peter Pan, as the Bank of Japan's Haruhiko Kuroda said, back in 2015, if you believe that you can fly just by believing in it, then maybe it has some positive effect. So what you're saying, Steve, is exactly right. What Wall Street wants from the Federal Reserve is not bank reserves. They want the Fed to come out and say, we're doing something. We have either fixed this problem, so go back to being normal, or we're going to do something big to get everything moved in the right direction. Either way, it leads to people stopping and think, I don't need to sell anymore because the Fed is my friend. The Fed is doing something. I don't know what the Fed is doing, but it's doing something positive because everybody says it's doing something positive. And so I'm not going to hit the sell button. I'm going to hit the buy button here.
Right. And that's a key point here on why this SOFR thing matters so much, because what it's really saying underneath the plumbing, and Jeff, I'm just echoing what you said earlier, is people that have money that normally lend in the overnight markets don't want to. Now, for whatever reason, it doesn't matter. They don't want to. Now you ask yourself, will a rate cut fix it? Well, it didn't. We just had one. Will QE fix it? No, because it doesn't put money in the hands of people who don't have collateral. And that's the exact point here. Its whole thing is not going to fix it. But as long as Wall Street convinces everyone, that's the key point. And maybe somehow enough sentiment goes up and people flood into the markets and everything kind of starts working again. But if it doesn't, then we've seen this before again. Watch out below.
What is a Eurodollar University membership? It's where understanding the monetary world isn't a mystery, it's a method. If you're serious about your financial education and you want clarity in a world of volatility and misunderstanding, this is for you. Mainstream education has left so many gaps on the most foundational concepts, making sense of everything is practically impossible otherwise. With our memberships, we'll fill in everything that you've been missing. Whether you're starting out or sharpening your edge, our memberships scale with your goals. At Eurodollar University, we teach you about how money really works so that you can evaluate fundamentals and make grounded decisions. With a Eurodollar University membership, you get a comprehensive library of foundational and advanced lectures, in-depth case studies and real-world analyses, live Q&A sessions, regular updates on macro trends, and even some central bank policies. And most important, how to interpret critical derivative market signals you will not find anywhere else. You can't be in position to succeed if you don't know how it all really works and fits together. So if you're ready to explore, master monetary systems, both past and future, with structure, clarity, and confidence, click the link in the description to visit eurodollar.university/memberships to join us today. Yeah, so we've been talking about the cockroaches in private credit that have come out, and there's probably going to be more that do show up still. And that's really the problem here. It's not about sentiment. This is the reason why sentiment isn't going to work. Because you and I, Steve, we know this only too well. We've been talking about it this entire time. But I think most people know this intuitively. They have a feeling of it. There has been a ton of really stupidness that's been going on the last couple of years. And all of it is, first of all, human greed and human nature. We see this in every credit cycle, and ever since there have been credit cycles, where people convince themselves that It doesn't matter. Jay Powell gets on TV, says the economy is strong and resilient. Who am I to argue against Jay Powell? He's the chair of the Federal Reserve. So I'm just going to lend to everybody and anybody. It's the same type of behavior we saw with ninja mortgages back during the housing bubble 20 years ago. People rationalize doing stupid things. And the longer they get away with it, the stupider the stuff becomes. And the more that Jay Powell says, don't worry about it, strong and resilient, the more they're going to do it. And so what we know is, and what we're starting to see is that, yes, there really was a whole ton of stupid. And while everybody is lending and just lending, not asking questions, they're also not checking in on the collateral. They're not checking on the details. They're not really, verifying, do we have a liquidity backstop? Do we have everything we really, because they convince themselves we'll never need the collateral. The economy is going to be strong forever. It's only going to get better from here. We don't need to check to see if we have collateral because we'll never need it. We'll never have to use it. And so as all of that stuff builds up, and then suddenly people start to question that, it's not so easy to get the horses back in the barn. Once they're out, they're scattering all over the place. And so now everybody says, oh, hold up here. We actually did a whole bunch of stupid stuff. And when we look at all the details, it only leads to more questions and more problems. So it's not so simple as fixing it by lowering the federal funds target rate by the Federal Reserve or introducing a couple more bank reserves. The repo market doesn't care about bank reserves or the federal funds rate. The repo market is saying, there was a whole bunch of stupid that took place that everybody is now aware of. And if everybody's aware of how much stupid there is, where does this go in the future? It only goes in one direction. And that's the downside of a credit cycle. And the downside of the credit cycle only ends when all of that stupid has been expunged. And the only way to expunge all that stupid is to have people start taking losses.
So, Jeff, why do people that have cash want to hold it? And I think you kind of been saying this, but let's dig deeper here, because before the show, we talked about the delinquency rate, which a lot of people don't really pay attention to. But for a lot of subprime borrowers, it's at the peak of where it was back in the financial crisis. And as you said in the beginning of the show, it doesn't go up until after there's a crisis, big layoffs. We haven't seen it. And again, we talk about cockroaches. You talk about, are loans properly collateralized? Or are they double collateralized because someone else is calling it their collateral? And that's the problem. The people that have money right now are saying, look, we don't know what the truth is. The problem is, every time we think everything's okay, another cockroach comes up, or the delinquency rate goes higher, or another company announces a layoff. And we're very uncomfortable here. So again, you come back to, do rate cuts magically fix things? Well, if you're behind on your car payment, is the Fed cutting rates somehow going to make the payment? Of course not. If you need cash in the system, is QE coming in and creating some more bank reserves going to put cash in their pocket? Of course it's not. These things don't fix it. But what it does fix, as you said, Jeff, it fixes sentiment, maybe brings some people back into the markets, get some money flowing, get some liquidity there, and maybe things settle down. But that's why every time it settles, it doesn't fix it. Wait a week or two, and next thing you know, we're right back at the same issues again.
Yeah, when you talk about QE, even if QE was money printing, think about it this way. If the Fed shows up tomorrow and hands you with a chunk of money, he said, hey, I'm going to lend you $10 million. Are you going to re-lend it into the economy? Right now? No, it doesn't matter if you have more bank reserves or not. You're going to say, maybe I'll buy a treasury, but I'm sure as hell not going to lend in the real economy in any kind of way. So, even if the Fed did print money, and even if the Fed did have the ability to interject that into the banking sector is saying, no, thanks. I don't want anything to do with it. That's what the repo rates are telling us. It's not about bank reserves. As the repo range continues to creep higher on trillions and trillions of dollars, and by the way, we don't know what the repo rate actually is for the vast majority of repo, which takes place offshore outside the U.S. in a way that is not tracked nor monitored. We're kind of hoping that the repo statistics that we do have, like SOFR, are somewhat representative of the entire repo market. But we don't know. The repo rates and the repo illiquidity might be even worse outside the U.S. across the entire Eurodollar system than what we actually see. But so the real important point here is what the markets are starting to see. What I think the Bitcoin signal to me, the part that I'm taking is that there's growing awareness that there is a lot here there's more wrong than there is potentially right. And I think that's what's gripped the marketplace. You see that in WTI contango. I mentioned that one. WTI curve went almost perfectly straight across this past week. It went back a little bit into backwardation because of more geopolitical risk and sanctions and all that kind of stuff. But what the contango signal is, and this is a dependable downturn deflation signal that you'll ever see, one of the most dependable ones that are out there. And that's when we see the curve that goes straight across and we get contango at the very front and contango in the very back, what that suggests and what that indicates is that the market is confirming the signal that we're getting, which means, as I just said, downturn, deflationary conditions, which, by the way, is exactly what we're describing when we're talking about the repo market, the Fed having to respond to it with maybe doing QE, and all of the financial volatility that has suddenly showed back up again after the summer when everybody was convinced that we had left all that stuff behind.
Jeff, I want to talk more about crypto and Bitcoin here because for me, and now just for full disclosure, I've never owned it, never traded it, but I do look at it because I find it very fascinating. I think it's one of the best proxies of liquidity that you can get kind of a real-time pulse on, because I think that's where money goes. And when you see price go up, it tells me there's liquidity flush in the system. So today we saw people come and buy the dip on stocks. But what happened? They bought same thing. They came in with crypto, but it's sold back down. So I look at this and say, look, money's draining from the system. I can't connect the dots as exactly how or why, but in my estimation, where crypto is headed right now is telling me where equity prices are going to go, tells me perhaps, that oil is going to come down. It's telling me there's a lot of trouble in the system that's being echoed in the SOFR rates and kind of all throughout the system.
Yeah, I mean, it comes back to just, again, the common sense. We were in a credit cycle. We've been talking about this for a long time. And there's only one way for it to end. There's no other way to end when you have that amount of insanity take place and just over and over and over again. Eventually, you have to have a credit, downswing of the cycle. I don't want to call it a credit crisis or a credit crash, but you have to have that type of, losses need to be assigned so that the system can clean itself out and get ready to start, growing all over again. But the point that we talked about this before the show, and the one that you just raised, Steve, is what are the proportions that we're talking about? And I think that's what's starting to seep into the consciousness of the marketplaces and even among Federal Reserve policymakers. Delinquency rates that we've, not just on subprime loans, on regular loans too, delinquency rates are getting up to where they were in the aftermath of 2008, 2000, which means delinquency rates in 2010 and 2011. Because normally in these cycles, you don't see that type of real spike in bad loans until after the unemployment really starts to hit. And as we've been talking about for the last little while here, we expect the unemployment is still ahead of us. We haven't seen the worst of layoffs. We haven't seen the flattest part of the beverage curve. And delinquencies are already up here where they were in 2010 and 2011. So just simple back of the envelope extrapolation here. What if we do get more layoffs? What if we do get, 100 more Verizons? What is going to happen just in the credit? I mean, that's bad enough in the real economy. Just set that aside. What's going to happen in the credit markets where delinquency rates are already equal to 2010 and 2011 before we even get a sharp rise in unemployment? There's too much uncertainty that is becoming more certain, not less certain, as we get more and more, as you said, Steve, more cockroaches pile up. As more cockroaches pop up, they all sound and look the same way.
Yeah, in fact, that's what I was kind of thinking. I can only imagine some overnight lender saying, okay, we'll loan, here's the cash. And then the next day that company's out of business because we needed the money because, we're going out of business. And I think that's a very real risk here. And so you start looking at things like, people often wonder, why do things like, crypto, obviously we didn't have it in previous cycles, but why do things like gold sell off going into crises? It's because the bottom line is you get behind on your house payment, you get behind on your car payment, your boss is telling you you're going to lay you off. You got to make payments and you can't go to your 401k. I mean, you can, but you got early withdrawal penalties, you got taxes. So you sell the things that you're liquid and you can get out of. So that's why as I see kind of crypto selling off here, it's a major red flag against the fact, as you said, Jeff, not only delinquency is high, but if we get more layoffs, which I think is very realistic in the first quarter of next year, I think as we get closer to Christmas and the sales numbers don't hit, at least that's my assumption, you're going to hear a lot of companies start to lay off. They have no choice. When that happens, delinquencies are going to surge. The next thing you know, this liquidity problem, it's going to ice over because anybody that has money isn't going to lend it to anyone for any reason. And then next thing you know, that's where the system really grinds to a halt for me.
And as we know, you're always thinking ahead. You're not waiting to, if you have to wait for confirmation of everything that Steve just said, you're a dinosaur. You're already too late. So as the probabilities rise for a situation like that, more and more people they're not gonna wait for the next layoff announcement. They're not gonna wait for the next cockroach to come out. They're just simply gonna do what the UBS hedge fund investors did and say, just give me my money back. I don't care about anything else. I don't care about crypto. I don't care about QE. I don't care about the Federal Reserve and its rate cuts. I don't care about the federal government and its tariff dividend. I don't care about anything. Just start giving my money back. And the greater the chances are, the more we see job losses and potential for more, the more people are going to ask for their money back, which means more illiquidity, which leads to more questionable collateral, which means more questionable economic circumstances. And you really do get into that vicious cycle. And that's really the risk here. And I think that's what's starting to impact the marketplace, whether it be stocks or crypto or any other marketplace. The idea was it was all about tariffs in April and March and April. It was all about tariffs. Everybody overreacted to tariffs. And once we got past that, the world didn't end where everything is fine. So we get farther enough away from that. This is why things are always a process. We get farther away from March and April, you get a little bit better perspective, and you start to see, with the labor market losing jobs, with all these cockroaches showing up in private credit, oh crap, it wasn't about trade wars. It wasn't about tariffs. It's about all these other things that we just talked about too much stupid, about a credit cycle. And in that situation, it's not about sentiment anymore. It's about, hey, get me the hell out of here while I can still get out.